Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
And we're back. Glad to be here. Hope you guys will be glad after today's show, because I got news for you. The correction that you've been seeing, kind of it's garden variety, really. If you look back to, let me see, I guess it was last January 2018, you saw the same sort of thing. It's a big sell-off happened over just a few days, and then the market started, it stayed a little volatile. Kind of near the end of the year, started to take off. By the way, you saw that the year before last, too. You've seen this. This is almost a recurring theme now. In fact, that's what we're going to be talking about at the very next seminar, which I have to look up because I can't remember the date. I'm going to my own website, bullingtoncapital.com. I type in Bullington, there I come up, and I'm waiting for the website to pop up here. There we go. Click on the seminar tab. And it is, yes, this is going to be a Saturday morning, October 27th. So that one's coming up pretty quick, 2 weeks from now. We're going to be talking about coming into what has been the best 6 weeks of the year for the past few years, and why. Why is this a repeating pattern? I'm really not sure completely, but I do have some hunches, and we're going to be talking about that. A lot of it has to do with the fact that so much money now is managed by institutions, and there are a lot of hedge funds out there who have a fiscal year end. What does that mean? Why should you care? Well, see, what happens is when you've got a hedge fund, they're getting a percentage of the profit that they generate that year as part of their compensation. So the last few weeks of the year, if they can take out whatever money they've had in cash and put it into the market and get the market to go up, they get a big raise. Woohoo! Because they're getting a raise. They get a big bonus. And I'm pretty sure with the popularity and the growth in funds, private funds like that, and public funds, that's a real thing now. So at least that's one explanation. Whether it is or not, we will never know, because you would have to poll all those funds to find out what they were doing and why. And there are thousands of them. By the time you finish the poll, their opinions would have changed. Will have changed. Anyway, so you can go to my website, bullingtoncapital.com, to sign up for that online. It's free. It's a lot of fun. It's going to be a Saturday morning. I'm going to get you in and out of there quickly. I've taken an oath. Gary, the guy that does the trading and IT and a whole bunch of other stuff, and Melissa, we've got a great team. The three of us do a lot. Between the three of us, we have a team at both Folio, Institutional, and Fidelity Investments that work with us to help us serve our clients. It is really nice. We do an awful lot of stuff, and they have agreed to come up and pull me off the microphone if I go past an hour. So I'm not going to go past an hour, by the way. I'm probably going to go about 45 minutes, and then I'm going to take questions. I'll take questions for 15, 20 minutes. And I normally hang around after the program. So if I'm late coming in that day on the radio program, you'll know why, because we're going to be doing the workshop. This is a good time. This is an excellent time. The market's down a little bit, and it's really not down all that much. It's down about 5.5% from where it was a couple weeks ago. That's not that big a deal. That's actually pretty light, quite frankly. Why is it going down? Nobody really knows. When you're watching the television and they're giving you a reason, they're just giving you a reason. They're trying to figure out why, and they don't really know, and they won't know, and almost ever. Markets have a tendency to move kind of randomly in the short run, especially when you've got a bunch of funds like you do now, and the number of funds outnumber the available stocks for them to invest in by a number of at least 4 to 1, minimally, there are 4 times as many funds as there are stocks for them to invest in. That's one of the reasons that I've taken an approach at Bullington Capital to kind of go on a rules-based investing practice. We've got multiple models. We try to match up the models with the personalities of the investors. And we can accommodate young people, and we can accommodate people that are retired. When you're retired or you're nearing retirement, you don't want strategies that are going to take an extremely long time to recover from a big correction. That's not fun. When you're retired, you don't want to take a long time to recover. So we would run a portfolio differently for that person than we would a young person who just wants to make as much money as they can. If you want to make as much money as you can, you have to put up with more fluctuation. And that's not the thing that somebody in their 70s wants to really hear about. There's a whole lot of fluctuation. I mean, you're going to get it. You're going to get fluctuation, but there are levels. There are levels of fluctuation. So we're going to talk about that in detail because that's part of this whole thing with what's been the best 6 weeks of the year over the past few years. The last 6 weeks have typically been the better part of the entire year for the last few years. And why is that happening? What can you do about it? What can you do that's conservative? What can you do that's going to try to be a little bit more aggressive to take advantage of that? We're going to talk about the 2-minute retirement plan, which I'm going to talk about constantly for the rest of my shows. It's not going to be the only thing I talk about, but I am going to mention it. And here's the thing. You are never too young to start planning for retirement. You are never too young. And I know a lot of the young people are rolling their eyes right now. That's okay. Yeah, I'm going to tell you anyway. It takes an enormous amount of money to be able to retire. I want you to think about something. For every $10,000 that you want to generate in retirement income, you're going to need over $200,000. So to be able to spend $10,000 relatively safely. Now, I'm not talking guarantees like a CD. I'm talking you're going to have to have a balanced fund, stocks, bonds, and cash, and you're going to have to stick with that, and you're going to have to put up with some risk to be able to spend $10,000. So that's a lot of dough. $10,000. You need $250,000 at 4%. At a 5% withdrawal rate, you need $200,000. That's a lot of dough. That's hard to do. That's just for $10,000. By the way, the average Social Security payment, I just looked this up for this show, $1,400 a month. That's the average Social Security payment. That's pretty good. That's actually very good. $1,400, $1,000 a month. Then you take the other 4 times 12, 48. That's close to $15,000. $15,000. Do you realize at a 5% withdrawal rate, you'd have to have $300,000 in an account that's still taking risk to be able to spend the 5% that equals the $15,000. So somebody who has $1,400 a month in Social Security, it's the same thing as having $300,000. Now, when you hear people complaining about the Social Security and the measly check that they get, it's because nobody's ever explained it to them that way. Say, yeah, you know how much money that would take? So that's pretty wild. That's tough. And I have a handful of clients who never have to worry about money. They're never going to have to worry about money. And a lot of it's, there's a lot of different ways. In fact, I don't have any two people who've had similar experiences in their lifetime. Can you imagine that? I have about 180 households that we service, the group of people at my firm, about 180. No two of them are identical. None of them are identical. That blows my mind. So anyway, what's really funny is a husband and wife will sit down and, they're kind of doing this thing together. Oftentimes we have to do the 2 separate retirement plans because they don't agree on anything. And that's when I get to put my psychologist hat on, incidentally. I didn't know I was going to have to be a psychologist when I got into this field. I'm sure I would have paid attention more to my psychology classes in college. But we often have to do that. In fact, I'm very fond of saying investing is really, it's 95% psychological. I can prove that. And I'm going to start proving it here in a few months, actually in a couple months. Bought a piece of equipment. We're going to be able to put together some explainer videos that explain that in more detail, because a lot of people accuse me of talking, in cryptology. I don't know what you're talking about. Well, it's because I'm leaving stuff out because I'm on the radio and I don't want to bore everybody to tears. So if I can put a 90-second video together to take these little ideas and make them short and quick, and you can put them together yourself. But psychology is very important when it comes to investing. It's extremely important. And I feel so strongly that this information really needs to get out there. Other people have published very similar stuff, but I'm one of the few people I know that's ever read any of that stuff. It's amazing. And I give an example of what I'm talking about. Look at the S&P 500. The S&P 500 is made up of 500 companies. Why do the top 50 companies make up half of the index? Why? Why does it work that way? Well, it's because it's market cap weighted. I'm not going to bore you with the explanation on that. I'm just going to tell you that's not such a good thing. It's not. Half of your value is in 50 stocks. You're holding 500 of them. You know what that means? The other 450 stocks don't have a lot of impact on that index until one or two of them actually makes it into the top 50. It grows big enough to make it into the top 50 and can muscle some of those others out. Okay, but what happens is, and this is an unintended consequence of managing money that way, the largest stocks have the biggest impact on the index. That's not always a good thing, especially when those large stocks are overpriced. If the overpriced stocks keep going higher, the way they've been doing for about 5.5 years now, if they keep going higher, you get another crash, just like you had in the year 2000. That's not good. You want to try to avoid that. And there are ways of avoiding it, or at least minimizing it. Number one is don't have all of your money in stocks. You shouldn't do that. It's not a good idea. You should have some of your money in bonds, and how much you have in bonds. And they should be really short-term bonds today. We'll talk about that next week. Today we're going to talk about stocks and the types of stocks that you should have in your portfolio. And we'll be going through this stuff continuously. And how does that play into a retirement plan? The vast majority of people that I talk to come in and say, well, yeah, I would like to have a 5% CD. Could you make that tax-free? And yeah, no. Sorry. That doesn't exist. And if I had a magic wand, I would certainly use it and wave it and give you what you wanted. But we have to work with what we have, not with what we want. And occasionally, I think what was Henry Ford used to say about his Model A's that you could have any color you want as long as that color was black. You can have any investment you want as long as you pick from those you have available to you right now. That's what we're basically saying. I like his phrase better. But anyway. So we're going to be having this seminar. It's the best 6 weeks of the year. We're going to talk about that. I'm going to be talking relatively quickly. That's actually not that hard. I'm just going to show a few graphs. What you can do, what I think you can do, and I have to tell you, I watch every day. I run scans. I'm actually buying and selling. Yesterday, there was only one stock that came up that I thought looked really good. It looks good. It's got good underlying fundamentals. And actually, there were two, but one looks better than the other one. And it's an oil and gas equipment and services company. Now, here's what I do on the weekends. Number one is I'm boring. Because I like to go and I look at the top 10% of all stocks over the past 1 month, 3 months, and 6 months. So that list, there are 300 stocks in there. And I'll go through each one of them just quickly. I know what I'm looking for. And 19 out of 20 times it's not present. Okay. So I'm going through quickly and I'm looking there and I'm making observations. What are the observations I'm making? I'm observing which companies, which industries, or which stocks in which industries are coming up and seem to be coming up more frequently. Now, it's been really interesting the last, while the market's been dropping, the oil and gas equipment services companies have been coming up a lot. Gold stocks just started coming up a lot. Now, I know that excites a whole lot of people because I love to try to play gold. And when I say play, that's what I mean, because gold has no fundamental reason. It's kind of like Bitcoin or these digital currencies. These things don't produce anything. They are an object. In the Bitcoin case, it's an object. It's a digital object. It's not even a real. You can't even touch it. They're basically objects. They don't produce anything. A company that produces equipment that's used for oil and gas, they're actually producing something, that equipment. That's what they're producing. And they're selling that equipment and they're earning a profit. See, that there's a big difference. And if you don't understand that difference, and I think Warren Buffett once said, he was talking to people about value investing. He said people generally either got it right away or they never did. And if you don't understand why it's important for a company or for something you're going to invest in to be able to produce something of economic value, then maybe you shouldn't be investing. Realistically, you probably shouldn't be investing. Although those are the people that have a tendency to love to do it the most. Yes, I guess ignorance is bliss sometimes. But anyway, I'm going to try to help you too. It's very frustrating, but I'm going to try anyway. And I've got I bought a piece of equipment that I'm actually going to try to help you with. I'm going to put a bunch of videos up online. The equipment hasn't come yet. It hasn't even shipped. So it's going to be a couple weeks from now. But I'm going to try to explain the basics in really simple language. Really simple language. I'm going to explain some of the models that I like to use. I like to call it math over emotions. Let's use math instead of emotions. Now, what do I mean by that? What do I mean by math over emotions? Well, you could buy stocks based on the dividend yield. That's math. You could buy stock. One of my favorite models is to take a measure of cash the company's generating. We're going to call it EBIT. And we're going to get back to the rest of this explanation after these commercial messages. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned. And we're back. So you're listening to, well, that's a nice song. Yeah, you're listening to the Bullington Capital Report. I'm here every Saturday morning from 11 to noon. Feel free to call us, 216-901-0945. And, I'm, trying to focus a little bit our firm on the things that we like to do and things that we feel like we're most strongly suited for. And that would be retirement planning, retirement income planning, and asset management. Okay, so it's two things actually: retirement income planning and investment management. It's never too early. Planning for your retirement, and maybe you want to retire at 50. Do you know how much that's going to take you to do? It depends on the lifestyle that you want to have. It depends on a lot of things, and these are the things that we try to help our clients with. We have to talk about them fairly frequently. Everybody's different, and that's one of the reasons that you can't put out something. I mean, I can give you a 2-minute retirement plan, take 5% of your retirement savings and whatever you're going to get from Social Security and or a pension, and there's your lifestyle. Okay, that's less than 2 minutes. It'd take you a little bit longer to figure that out, but that's really, when I say figure that out, I mean you have to get a copy of your statement from Social Security Department, which, by the way, this is really weird. I was getting my annual statements, and I like to get them mailed to me for some reason. So I was getting them mailed to them and online. I was able to access it. And then suddenly they changed, And because when I was 16, I got a Social Security card so that I could get a job and start working. But I didn't use my formal name. I used Bill Bullington. They have that on record, and they froze my access 40 years later. 39 years later, they froze my access because I had originally, as a 16-year-old, I didn't use my formal name. So now I have to go down and prove that, yes, this is actually me. And so I'm taking the estimates based on my age and income that you can get right on the Social Security website. So you can get that right on the Social Security website. Then you take your savings. And here's the rule of thumb for savings, okay? You would like to try to start out at 4%. 4%. There's a 4% rule as College for Financial Planning talks about. I'm not going to go into it right now. I normally use 5 because of what I'm doing, but it also depends on how old somebody is. If somebody's younger, you're going to have to be more conservative. If somebody wants to retire in their 50s or early 60s, the 4% rule is a good one. But this is how this 4% rule actually works in the real world. Okay? You take 4%, they were talking about in the 4% rule study, increasing that each year for inflation. And I'm thinking, well, yeah, maybe. All right. But you could go as high as 6% in any given year. You could go as high as 6% in any given year. Why would you want to go 6%? Well, if you're in a balanced fund with stocks, bonds, and cash, and let's say you're 50% stock, 50% fixed income, and the market takes a big dip, which it has a tendency to do every now and then. If it takes a big dip and you're trying to take out the same money you took out last year plus inflation, okay, it's going to be more than 4%. So you could go up to 6, but you don't want to go much higher than that. And by the way, I just got that rule from institutions. That's one of the ways they manage endowments. They try to keep the distributions between 4 and 6%. And that's how they do it. They take a look at the account balance. So you have to look at that once a year, determine what your withdrawal rate's going to be for that year. And that's based largely on the investments that you make and how they perform, which is another thing. Now, almost everybody, I would say 99% of the general public, looks at one thing when they determine whether or not they want to invest in a fund. They look at the past performance. Let me emphasize past performance. That's what they're looking at. And that is woefully inadequate. That is so dangerous, you have no idea. Unbelievably dangerous to do it that way. Yet that's what 99%. That's why those studies that you see from companies like Dalbar, who study the investor behavior, that's why they come in so dismal. The average investor has made somewhere around less than 2% a year over the past 20 years. Less than 2%. And by the way, Dalbar doesn't manage money. They sell their research to people like us and the general public and pension funds. And it's one of the reasons that I'm a big fan of having pensions, which are going away, very quickly, is because it takes the investment decisions out of the hands of the average person, because they're just not going to do well. They're going to go look up to see on some website which funds have performed the best. They're going to put their money in. They're not realizing that those funds have done very well in the most recent past, and in the super long run may not have done that well. That's exactly what's happening right now. Large cap growth. The Facebook, Amazon, Netflix, Google's, Apple's of the world, they've been dominating. Those stocks are no longer cheap. But if you're looking at the funds that have done the best, they all show up in them. They all show up in them. So if that's what you're doing, you're using the past performance, well, guess what? The chances that those guys continue to outperform as much as they have in the past are extremely small. Extremely small. And I've had some of that. It's been a portion of the portfolio. But we also have a bunch of dividend-paying stock funds and dividend-paying models. Why do we do that? Well, because the dividend-paying models have a tendency to be a little less volatile, and they tend to recover quicker from a big decline. Let me say that again. They have had a tendency to be a little less volatile, and they've had a tendency to recover much quicker from a decline. Why is that important? Well, it's important because most people don't want to be down for 10 years in a row or underwater for 10 years. the way the S&P did, the way the large cap growth has a tendency to do every now and then. So if you don't know that, you've got a problem. If the financial advisors that you're talking to don't know that, you've got a problem. Because the easiest thing for a financial advisor to sell, by the way, is something that's just gone up the most. That's the easiest sale on the planet. You're like, hey, look, if it only does half as well. Yep, guess what? That's an easy sale. You better take a look at what the holdings are and how those stocks are being selected. And understand that when one category dominates like that, we've been hearing a lot of talk about values coming back, and it is. I see it. I see it in the portfolios that we manage. The values they're closing the gap. They were underperforming for quite a while. So is value the way to go now? I think there's probably still a long way to go. But I think if you're looking at over the next 10 to 20 years, instead of the next 6 months or a year or two, if you're looking out super long run, yeah, it makes even more sense because the valuations are lower there. You're not paying as much for those companies. And a lot of those companies are actually fairly high in quality, some of them very high in quality, but because of their size, they're not getting the attention that the Facebooks and the Amazons are. And they're not getting the dollars invested in them the way that those stocks are. So if you're looking out over the next 10 or 20 years, instead of the next 2 or 3 or 4, that's a pretty good thing. And I know I'm focusing people on the last 6 weeks of the year. Yeah, is that a smart thing to do? Well, when you're looking at why it's happening, what's happening, I think yes. We're not talking about it in the context of a trade. I'm going to be talking about this in the context of what's going to happen. You're going to want to buy some of the stuff that's undervalued right now. And it may not even be the best stuff for the end of the year. It might not be. In fact, let's see. Yeah, last year, one of the top performing categories actually went down in December. One of the top performing categories over the last 10 years went down in December last year. It had a great rest of it. 2017 was an awesome. And I take it, yeah. So in December, it sold off. But if you look at and by the way, it's at the prices now that it was at in November of 2017. The price is right around the same price in November 2017. Yeah, that's a good thing. That's a good thing because that industry is doing very, very well. Why do I say that's a good thing? Because the longer the value builds, the longer that value keeps accumulating. When that move does happen, it's probably going to be a big one. And it's probably going to be relatively fast. And it's probably going to be relatively volatile because that always scares everybody. It's a scary thing. Which is one of the reasons I have a job. Is to come in and say, hey, listen, don't be afraid. Now's not the time to be afraid. If you were listening to my show in the late 90s, it was a different story. Why? Because the prices on stocks were so far ahead of what they were actually worth that I was worried, like really worried. However, that was also very similar to what you're seeing today. The prices on some stocks were so far ahead of where they should have been that you knew eventually they were going to drop a lot. And those stocks just happened to make up a large percentage of the S&P 500. That is eerily similar. Although today those stocks aren't nearly as far ahead of themselves as a lot of those stocks were in 1999. So I feel good about that. And the other thing I feel good about is a lot of those stocks are benefiting from this thing that I know a lot of people are probably tired of hearing about. I don't care. I talked about this in 1996, 97, 98, and people kept saying, oh, yeah, you don't know what you're talking about. And then 99 comes along and Qualcomm goes up 2,300%. Qualcomm owns the smartphone business, by the way. Their technology is what enables that. Everybody has to pay them. They're like a Don. Everybody has to pay them to sell one of their phones, to sell the Apple phone, to sell the Samsung phones. They're all paying Qualcomm. Well, guess what? They got really smart. That whole industry got really smart. This next technology, which is at least as important as the technology that enabled texting and enabled video over your phone, that's what Qualcomm owns, by the way. Those are what their patents are on. Without that, you go back to a regular old phone. No text, no video, no music, no internet. Think about that for a second. And one company. So they learned, that's the great thing about America. We don't figure out all the answers ahead of time, but we do learn pretty quickly, actually. But and they learned, all the companies learned, and they're developing this technology jointly. They're all contributing to it, and they're all going to get to share equally in it without having to pay one particular firm. And the technology that they're rolling out is called 5G. By the way, the old technology works with that. So Qualcomm's still going to get paid. But this round is jointly owned by a lot of the participants. It's almost like a open source, if you know what that means. Yeah. So anyway, it's called 5G. It was originally thought of, or at least one of the original reasons for this to even come into being, was for driverless cars. One of the main applications that was identified early on was for driverless cars, because driverless cars need to have a lot of information flowing back and forth really quickly. You can imagine. They're driving cars. They've got to be able to measure the speed of the car in front of them, the speed of that car, measure the closing distance, the cars to the left, to the right, to behind them. It's processing all that information all the time. It has to do it within 1/1,000,000th of a second. Okay, so this technology enables that. It's what enables that. And at some point in time, the people that were working on this said, hey, wait a minute. You know what? We can actually deliver cable television over this same technology. And you know what? We can actually deliver internet over this same technology. So we can do, by the way, works really good with cell phones. So you've got cell phone, internet, driverless cars, and cable television all using the same technology. And your wired houses, you're hearing a little bit about that now. That is going to be so passé 10 years from now. Everybody's going to have all of it. You will actually look around your house on your phone. You can do that now if you really want to spend the money and be able to do it. Sometimes it's going to look really slow. The picture's going to look kind of grainy. It's going to freeze up on you. That's because you don't have this new technology fully deployed yet. It's coming. It's come. I feel like I'm back in high school when I saw those ditch diggers laying down all the line for cable. Remember that? That's where we are. That's where we are with this technology. It's right at the beginning. It's at the beginning. And the industry, one of the industries, there are a lot of industries that are going to benefit from this. One of the industries, in fact, the whole economy is going to benefit from this. The whole economy is going to benefit big time from this. That's why I'm not worried about the economy for the next few years. You've got a major driver here. A major driver. See, all the people that work for the companies that are making the semiconductor chips that I keep talking about, they drive cars, eat food, live in housing, and wear clothing, hopefully. They do that. That contributes to the overall economy. Are the wages in that industry growing faster than normal? Yep, they are. Are they selling more stuff? Yep. One of the leading industries. Revenue's up 40% year over year. So that's really good. If you wanted to take advantage of that, you'd probably want to put a portfolio together. Grit your teeth because it's one industry and it's related to technology. It's going to be more volatile. But I have to take another commercial break. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned.
This old earth is fading, and our hearts are aching. So
And we're back. Hey, if you have a phone call, question, or comment, 216-901-0945. If you'd like to call and set up an appointment just to get to know you meeting, we can show you what we do at Bullington Capital, ask you a little bit about what you're looking for. And again, we kind of specialize in investment management and retirement income planning. Those are the two areas we spend most of our time in. Other areas we get into, we'll refer you to people that are specialists in that area if you have those kinds of questions. Questions like taxes, or you need to set up a special needs trust for a child. That's something you need to get specialized help in. And we have a network of people that we can refer you to that we like and that we've been working with over the years. So we really don't care. If we think we can help you, we'll try, even if it's referring you to somebody else. So, in fact, one of the things that a lot of people like to do is a thing called cash flow financial analysis. They like to take their incomes and kind of track where all their money goes. And it makes sense. I'm actually a goal-based financial planner instead of a cash flow-based. I don't like to track every dime. I like to set a goal and work towards that goal. If I have any money left at the end of the month, great. I'll do whatever I want with it. At that point, it's discretionary. Maybe I'll save it. Maybe I'll get something I really like to do. Maybe I'll, my business budget, I run that the same way. We have certain goals that we like to achieve. And so it's just a different way of doing it. And not everything is for everybody. That's one of the things I've really learned in this business over the past 30 years. There are multiple ways of getting to the right conclusion. And some of them have some things in common, but oftentimes, you can be taking different paths and ending up still doing the right things. So what do I mean by that? Basically, somebody that wants to really analyze every dime where all their money is being spent. There's a guy that's also on this show, or on this station rather, that is really good at that. And that's called cash flow planning. We're goal-based planners. So a retirement plan for me is going to look like you have to tell me what your budget needs are, and I can tell you how much in assets you need to accumulate to try to meet that need, and we can put together strategies based on your particular tolerance for risk to try to stay within those guidelines to meet those needs. That's not always that easy. Because oftentimes, there's an educational process to go through. People look at the S&P 500 have been so marketed so well, and it does very well. If you get a long enough time period, it does very well. It also has very long time periods where it doesn't do well. I mean, it's got extremely long time periods where it doesn't do well. If you look at go back to 2000, it was at its high, it was 1552.87. It traded at that price again in 2013, and the dividend yield was less than 2%. So that's a 13-year time period where the principal, not including the dividends, was actually negative. So I don't care what it's done since then. And that's one of the problems with just looking at the performance. That if that's all you know, you've got a problem. If you're looking over the past 1, 3, 5 years, that doesn't solve it. You've got to figure out what they're doing with the money, how they're making the money. That has more to do with the long-term success than just about anything else. And this is another thing. Well, it's one of the reasons I'm doing these educational videos, because I've been talking about this for about 30 years. And it has changed over the years, by the way. Markets have changed. The S&P behaves differently than it did. The number of up or down days that are 2% or better, we had 3 last week. The days were more than 3%. That's pretty mind-boggling. Yeah, that used to almost never happen. You can thank computers for that. But so it's even more important today that you have some strategies that are founded in fundamental concepts. And it can be a bunch of different things, but you need to know what those are. And if you don't know what they are, then call your advisor. You got a question? Call him. Ask, or her. Ask, say, what are we doing with this fund? What does that fund actually do? And hopefully they'll give you a fairly brief example. I'll give you an example. One of my favorite models is an individual stock model. And it wasn't my favorite 3 years ago. In fact, I didn't start running it until a little over a year ago. And it's called the BCAP value model. What I do is I take a measure of cash that the company's generating, it's called EBIT, and I divide it by the cost of buying the entire business. It converts that cash into a yield, so now I can compare one company to another company on a much more equal basis and on an important basis. How much cash are you generating for every dollar that I'm going to pay? That's what I want to know. Kind of like price per square yard in carpet or price per square foot in a house. There are two houses that look really similar, and you're going to pay $150 for one, and you're only going to pay $150 or $20 for the other one. Which one do you want? I'd want the $120. If you're buying something of equal value and you're getting a lower price, notice I make a distinction between value and price. That's something that is lost on a lot of investors. Many of them have been investing for a long time. It makes you wonder. Now I know why Dalbar does those studies and why the 19 out of 20 people don't do as well as they could in just a regular balanced account that was stocks, bonds, cash, and had large cap, mid cap, small cap, international, emerging market, all those categories, and index funds, short-term bond fund. That will outperform 19 out of 20 people in the long run. By a wide enough margin, by the way, I should actually increase my fee about threefold because we would still end up doing better. I'm not going to do that, by the way. So anyway, this has been fun. I've gone almost an entire hour and no phone calls. You ever sat in a closet and talk to yourself for an hour? The guys running the show are both like nodding, yes, we have. That's called radio. But I've been told I have a perfect face for radio. So anyway, if you heard something here and you'd like to talk, feel free to give me a call. Feel free to call us. And I apologize. I didn't finish what I was talking about when I was talking about the 5G and how that affects everything. It does. It affects everything. Well, maybe not everything. It's not going to affect how you prepare a taco. That it won't. Probably won't anyway. I don't know. Now I'll probably get all these Pinterest pins sent to me. Hey, look at this. Yeah, but I'm just kidding. It's going to change the way things are happening. And there are lots of other changes, by the way. There are lots of other things. Technology is the one thing where you can guarantee we're going to be living differently 5 years from now and a lot differently 10 years from now than we are today. Look at where we were 10 years ago, 2008. Okay? Internet speeds have ramped up gigantically. Some of the stuff that I can do that I couldn't do 10 years ago, that's mind-boggling. And, oh, by the way, I do want to make sure I announce, again, Look Out for the Bull is coming back. We're working on it right now. We're working on Look Out for the Bull. We're going to talk about the value portfolio that I just mentioned earlier. That's going to be added on later. We're going to talk about a model of investing that uses price movement as its primary factor. A lot of those are real popular now. So, and those are the more fun ones, by the way. But anyway, I got to take a real quick phone call. Tony, do you have something for me?
Yes, Tony from South Euclid. How are you, sir?
Good. How are you?
Very good. Listen, financing has always been my confusion in life, so that's why I do everything. Hopefully, or try to do everything on a cash basis. Listen, I got a simple, but I got a hard question for you, if that makes any sense.
Yep. Oddly enough, it does.
Okay. My situation is I have a few assets, a vehicle, I rent, and I have Social Security. Maybe I'll be getting $500 to $1,000 a month when I retire. I'm in my 50s, and I pretty much have absolutely nothing. I have no investments. As I mentioned, only something in Social Security.
Right.
And what would you recommend for a person like me? No kids, no wife. Nobody loves me, but that's all right. But
well, that's not true. The God loves you. And but
I question sometimes that also, but bottom line, ground zero, this type of scenario, the basic fundamentals. I'm a basic
sure.
fundamentalist type of guy. I don't like to get too sophisticated. Right. I like the simple things in life. I don't have any health issues that I know of right now. I don't have any hospital bills. My credit is absolutely, I don't know if I want to say zero because I haven't used my credit probably in 25, 30 years. I don't have charge cards.
Well, Tony, here's what you could do. I think I know where you're going with this. And what I would do is this. We have a special relationship with 3 different custodians, Fidelity being one of them. I really like them. They have 0 minimums. You can buy some funds there. If you want to call me in the office, I'll meet you. I'll show you what to do. They don't charge a commission on it either. I hear the music, Tony. I'm going to have to run. I'm sorry about that. But give me a call in the office and we can talk about this. And for the rest of you, thanks for listening. I'm Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420 The Answer. Have a good week, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420 The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.